Welcome to Upsurge.club. In today's video, we will be discussing about index funds versus active funds. I will simplify this with the help of an example. Now let's suppose you're craving some ice cream. You go to Baskin Robbins to grab your regular vanilla. But your friend, not happy with the existing flavors, prefers to customize the ice cream, mixing and matching different flavors of chocolate and cotton candy. That definitely does not go too well, by the way. But let's get to the point. Passive funds are like vanilla ice cream. They have no distinct flavor to them. Rather, they simply replicate the existing vanilla in the market. In other words, they track an existing index consisting of a basket of stocks to generate the same returns. In contrast to that, mixing and matching different flavors of ice cream to produce something unique is how active funds work. They comprise a completely unique combination of stocks to outperform the overall returns of the market. Before we delve deeper into discussing the intricacies of index and active funds, it is important to understand how mutual funds exactly work. Go ahead and check out our video to make sure you grasp this one. While there are many funds in the market ranging from equity funds, debt funds, hybrid funds, pension funds, it's quite literally never ending. You could categorize all these in different ways. However, the difference broadly comes in from the management aspect. In simple terms, a fund manager's skill is involved while managing an active fund, whereas ETFs or index funds, which are types of passive funds, require no such skill. Now, whenever we invest into a particular stock or a bunch of stocks, we would either aim to generate returns at par with the benchmark index, which is in the Indian context could be Sensex or Nifty, or try to beat the benchmark by generating returns higher than that. Similarly, ETFs and index funds accomplish the former and active funds the latter. In simpler terms, ETFs and index funds track the performance of a benchmark as closely as possible. So if Sensex is generating a return of 12% per annum, they would also generate the same return of 12%. However, mutual funds have costs associated with them. So the return of index funds would in reality be less than 12% since costs such as expense ratio would be deducted, which is around 0.2% in most cases. Both ETFs and index funds are similar to each other in terms of their objective of replicating the respective benchmark indices and their returns. The primary difference is that ETFs can be traded during the day like a stock, while index funds can only be traded at the closing NAV, that is net asset value of the fund. In contrast to this, active funds are managed by an experienced fund manager who makes use of his or her skill to identify stocks that generally beat the returns of the market. While this comes with a hefty cost though. The average expense ratio of an actively managed large cap fund is somewhere around 0.95%. This difference of 0.7% in the expense ratio for an index versus an active fund seems small, but it has significant impact on the net returns generated by a fund. Now, before we go on to compare the returns, let me take you through the history of index funds and what exactly triggered the need for it. The mutual fund industry started in the early 1900s with the aim to serve people who did not have the time and skills to analyze and buy individual stocks. Such investors preferred the convenience of relying on a professional such as a fund manager who would research and execute lucrative trades in exchange for a small fee. This went on till the 1950s. It was in the 1960s that people actually started taking interest in the mutual funds. A group of scholars started comparing the performance of these funds with the overall market and realized that they had been underperforming the market for decades. This led to the introduction of the first index fund called Vanguard 500. Despite wanting to raise $150 million for it, John Bogle, the founder of Vanguard, only succeeded in raising $11.3 million. As a result of this, they were unable to even purchase all of the shares in the index. So they ended up buying just enough stocks across sectors to broadly replicate the index, and this sort of worked out for them. Vanguard 500 index funds currently has $766 billion in assets, even bigger than the AUM of the entire mutual fund industry in India, which stands at $480 billion. Quite fascinating, right? Now, before we delve into the comparison of active and index funds, let's first acknowledge that these funds consist of stocks having different market capitalizations. For instance, it would not be fair to compare small cap passive funds with large cap active funds. It's like comparing apples to oranges. Earlier, there were no rigid norms to categorize such equity funds according to their market capitalization. So fund managers in effect could pick and choose, mix and match stocks of any type to create a fund. However, on 6th October 2017, SEBI released a circular to formally categorize and rationalize mutual fund schemes to ensure that investors like us are available to make an informed decision. The categorization looked something like this. Large cap, which consisted of first to 100 company in terms of market cap. Mid cap, 101st to 250th company in terms of market cap. Small cap, 251st company onwards. As we all can see, there are just 100 stocks that fall under the banner of large cap, the least among all the categories. This is one of the reasons why large cap active funds have struggled to outperform the markets. This is because it becomes challenging and an uphill task to identify winners from a short list of just 100 stocks. This story is further validated by the performance of 25 large cap funds as compared with the Nifty and Sensex index funds for a 5-year period before October 6, 2017, as well as for a period starting from January 1, 2018 till November 15, 2022. If we carefully analyze this chart, we can see that passive funds have consistently outperformed active funds. The difference would be as small as 1% that could translate into a substantially high differential return when compounded. It was always difficult for active large cap funds to outperform the index consistently over a long term. On top of that, the practice of bringing some outperforming stocks from other categories to generate additional returns is no longer available. So index funds definitely beat large cap active funds when it comes to short-term returns of 1 year as well as long-term returns of 5 years. As far as active small and mid-cap funds are concerned, they have performed very well when compared with their passive fund equivalents. However, it's important to note that there is higher risk involved in holding such funds since they hold stocks of riskier companies, but the expense ratio of such funds would be much higher than that of index funds. Now, how to make a choice between active funds and index funds? While many active funds outperform the respective index, the majority of them are unable to do so consistently. In fact, there is hardly any mutual fund that has remained among the top 5 in terms of annual returns for more than 4 to 5 years consecutively. On the other hand, there are certain index funds that track an underlying ETF. You may have to pay a higher fee in such cases since index funds charge an expense ratio on top of the existing one for the underlying ETF. You may be wondering, why anybody would then purchase an index fund tracking an ETF? Well, ETFs often face issues of liquidity as investors may not find a buyer at the right price when one wishes to sell the holdings. Index funds essentially solve this problem since AMCs have higher liquidity in that aspect. To conclude, index funds tick more boxes for me as an investor. Well, that may not be true for you, so make sure you do your research and make a wise choice. Hope you enjoyed this video and you would share this with your friends so that the YouTube algorithm works in our favor.